Welcome to FM Radio, your go-to podcast for everything in the world of funds management. Whether you're an experienced advisor, a seasoned investor, or just starting your journey, we're here to break down the complex world of funds management, all in a way that makes sense. Each episode, we'll talk to the experts to get insights on everything from asset allocation to risk management and give you the inside track on how decisions are made. So tune in and let's turn up the volume on the topics that affect you and your clients. In this episode of FM Radio, we're going to be talking about interest rate cuts. Are they good for the economy and investors, or are there other factors at play? To help us unravel the enigma of interest rates is Elston Portfolio Manager, Alastair MacLeod. Good morning, Al. Welcome to the show.
Morning, Pete.
Now, Al, at the time of this recording, the cash rate is sitting around 3.6 and the Melbourne Cup is just around the corner. Could we be looking at another interest rate cut from the RBA? What are the punters predicting on that?
Yeah, it's always when Cup Day, you're betting on the horses or a lot of people are betting on rates, which way they're going to go, the other big trade of the day. So I think the direction is still very much for further rate cuts. But as anything in investing, often the timing is difficult. So whether they cut rates on Cup Day or whether they cut rates when they next meet in February, I think there's a balanced view of weight of opinion as to at what date that comes through.
Yeah, so we may see something happen on Cup Day, but they might just leave it on hold. But it's still heading in that general direction, given, as you said, if the unemployment stays in the right place, if inflation genie is still in the bottle.
Yeah, and I think, like you said, that it's those two levers. When central banks talk about being data dependent, it's typically about the labour market and inflation. Now, we've got a pretty big inflation print coming out tomorrow, so that will definitely have an impact about what the RBA decides. But like I said, I think the direction is still pretty clear.
So whether there's a cut next week or there's not a cut, we are heading in that direction. And the motivation, what are central banks actually trying to achieve? I mean, is it to stimulate the economy? Are they trying to ease us into a soft landing? What's your feeling on, I guess, which way to interpret it?
Yeah, I think you can take interest rate cuts where you can either a glass half full perspective or glass half empty. Now, the glass half full perspective is that, look, inflation is cooling, you're cutting rates to stimulate the economy. Typically, that's pretty good for business activity and for general growth. And with the backdrop of cooling inflation, then that's generally pretty good for markets. Now, in contrast, if you're cutting rates because maybe the economy is hemorrhaging, unemployment is really spiking, and you're really trying to turn around the economy, like it's heading for a recession and you're trying to turn it around. So typically the central bank will be cutting rates below the neutral rate in order to affect that. Then that's quite different. And if you actually look at market returns in that scenario, so that's the glass half empty scenario, then markets will probably be pretty challenged in that environment. So pick your poison. You glass half full or glass half empty. It could be quite good for markets, but there's definitely scenarios where a rate cutting environment is more trying to avert a recession. And that's probably the bigger question. Is a recession imminent, or is the rate cutting cycle more because inflation's cooling and we can cut rates to more neutral, and that's quite positive for markets?
And so given that, are you a glass half full or a half empty person? What's your general feeling?
Yeah, I think like whether you look in the US or in Australia, in the US particularly, the labour market is definitely cooling, but it's still at levels which, probably a decade ago you'd consider close to full employment. So it's not like people are being laid off left, right and centre. So I think that, employment, if you want a job, you can still get a job. It's just that, yes, the labour market is softening and that has changed a little, but we're nowhere near, I think, an economy that's hemorrhaging. So with that backdrop, I think, we're definitely leaning in the camp of glass half full. And there's far more rate cuts expected in the US. I think around 4 rate cuts in the next 12 months will be genuinely positive for the economy and, as a result, historically at least, for markets.
So if it is good news, if we think that the rate cuts are heading in this direction and it's good, it keeps the economy chugging along and we do see some growth, and that's also great for the general population. It's definitely good for homeowners with mortgages.
Yeah.
But is it necessarily good for investors?
Well, yeah, it's probably not great for retirees who have got a term deposit because you're reducing your income. But for most of the population who have got a mortgage, then yes, it's generally a good thing. I think from an asset perspective, typically when interest rates are cut, that's good for asset prices because they can help that you justify a higher price because of it. Like the textbook answer would be lower interest rates is good for asset prices, and that, from a stock market perspective, is a good thing. The problem I think we've got where this time, I'm always fearful to say this time might be different, but is that your starting point today from valuations is already very, very high. So whether you look in the US on a PE multiple, so like valuation multiple of 23 times, or in Australia of about 20 times, they're both very elevated relative to history, which can create problems for future expected returns because you're buying that asset already at a very expensive price. And like any investment, a lot of your return is often what price you pay for that asset when you buy it. So if you buy something that's really expensive, it makes it harder to generate an acceptable return just because of that valuation multiple that you bought it for.
So you're saying historically you haven't seen anything quite like this?
Not to the same extent. I mean, there have been periods where valuation multiples have been this level, and whether you look in the US or whether you look in Australia, you look over 1 year, valuation is actually a pretty poor indicator of returns. Like it's a bit of a crapshoot. In America, the AI thematic could keep running for another year. In Australia, the banks could keep running for another year. It's not a great guide. But with the benefit of time, when you stretch that time frame out over 5 years, then the returns start really consolidating around a very low number. So in the US, for example, historically, if you'd bought the market at around 23 times, your expected return is about zero over 5 years because that valuation is like a headwind. It just weighs against you and weighs against your return profile. Similar in Australia, we looked at it more on a price to book basis for a few reasons, but typically you bought markets at sort of current valuations, your return was probably more 4 to 5% over a 5-year period. So, and much more consistent than over 1 year because that valuation can really dominate that 5-year return profile. So that's why I think this time may be different where, rather than just a knee-jerk reaction, rates are being cut, that's a good thing, let's just buy the index. Well, the index is actually already really expensive. So it kind of creates a bit of a conundrum as to, well, where should we allocate that next dollar of capital that can benefit from a rate cutting cycle?
Yeah, and I guess what you're talking about too is there is that sort of, perception disconnect. People see, the shining stars of the US stock exchange. We've got the Magnificent Seven who are doing so well. You could probably from that get a feeling that the economy is chugging along and the US is going great guns. But I guess it's not necessarily a complete mirror of what's really going on at those other levels. I mean, we were talking before about the small caps in the States. It can be a very different picture for, outside the top companies.
Yeah, no, that's exactly right. And I think, you think about share market returns, that's not representative, at least in the short term of the economy. Share market returns are driven by earnings growth, by dividends, and then by expansion or contraction in the valuation multiple. Now, like I said, the valuation multiple is already very full. So that's what weighs against future expected returns. And I think because the share market is not the economy, if you actually look below the headline level of the cap-weighted indices, so in small caps, for example, in the US, so they have not had the benefit of that AI expenditure on infrastructure, on NVIDIA, on chips, on data centers, which I think in the US and the S&P 500 has been about 70 to 80% of the revenue growth and certainly of the earnings growth in the US. But if you look at the small cap index, so the S&P 600, it's a smaller companies, rather than having revenue growth over the last 3 years, which the S&P 500 has had, it's actually had about 14% revenue declines.
That's big. 14% is massive.
Exactly. And I think, the small, you think about smaller businesses, they're more connected to the local economy, they're less likely to be exporters, they're certainly less likely to be in the AI bubble. It's probably more reflective of the real economy, it's much more domestically focused. And I think whilst we're not in a recession, I think there's a disconnect in the US in particular between the share market, which is driven by this AI expenditure, and the real economy, which is much better reflected in the revenue that you're seeing coming through these smaller companies and the challenges they're facing in just general day-to-day trading.
And we've talked about this a number of times, so it feels like I'm a broken record, but we see a disconnect in a different way in Australia, don't we?
Yeah, exactly. We're at 20 times valuation, a very expensive valuation multiple in Australia, but it's really been driven by the expansion in multiple at the banks for very little earnings growth. So it's not an AI bubble by any means, but the similarity is it's a valuation expansion, but without any sort of earnings growth. So again, if you looked at the ASX 200, you might think, wow, the economy must be booming. But it's really not. And if anything, actually, earnings growth has actually gone backwards the last 3 or 4 years. So it really can be a bit beguiling. If you just focus on the stock exchange versus the real economy, they're not the same thing, certainly not in the short term.
So, given all that, where do you think investors should really be focusing? How are the Elston portfolio managers, seeing things in the medium to long term?
Well, I think that's really where active management really earns its stripes, because rather than just deploying capital passively into the cap-weighted indices, so you're buying the AI bubble or thematic, choose your own adventure, whichever one you think it'll be, or you're just buying the banks, you can actually allocate capital to areas which aren't caught up in that. So if you sit back and go, well, if the economy is going to be stimulated, if small caps are more connected to the real economy, if real estate exposures, which are much more sensitive to interest rates, it's an area where, pretty much has really underperformed the last, 4 to 5 years. If you can allocate capital to those areas that typically do much better are much more sensitive to interest rates, that don't have anything like the valuation premium in them, then you can actually benefit from a pickup in the economy far greater than just buying the cap-weighted indices. But you need to have discretion, and you need to pick your securities that are going to benefit from that and don't have that valuation headwind that the cap-weighted indices do.
Yeah, so you can't treat everything as a homogenous investment environment. You've got to kind of go, well, interest rates may benefit some sectors, and be very careful how you analyse those things.
Yeah, and I think that's where it's different this time, whereas you can't just, I don't think, allocate capital to the big company heavy indices. You have to be far more selective in where you put that exposure. So areas like commercial real estate, where if you think about, everyone knows that their house prices have probably gone up, but other areas of the economy, so aged care, industrial, storage, you think about how much inflation has gone through, the last 3 or 4 years. But you're just not seeing that in the prices of the REITs or these businesses that are invested in real estate. And then you think also about real estate, how sensitive it is to interest rates. So if we, particularly again in the US, if we have another 3 to 4 interest rate cuts, the benefit to that sector in particular, and then you put it next to its valuation, it's like, well, actually the return on capital or expected return on capital from an allocation to that sector, we would expect to be far more beneficial than allocating it to the S&P 500, for example.
So given all that, how are the Elston portfolios actually positioned? You're obviously very aware of the factors. Is it flowing through to some of the decisions that the team have been making?
So in a recent QAA, we did make a decision to go overweight growth assets, but not just blindly putting money into the S&P 500. We went overweight global real estate and global infrastructure. 2 sectors which are more sensitive to interest rate cuts. There's some inflation qualities as well that over time will be borne out. And again, we think particularly with real estate will benefit from an improved economy, from an improved outlook, from rental growth, which is just not reflected in the valuations for a lot of these businesses at the moment.
Well, Al, that's definitely given us a lot to think about. Obviously, you're thinking about the Melbourne Cup a week away. I don't even know who's running. Hopefully, you've got some good tips for me on the day. But thanks for giving us, such a strong perspective on interest rates and the reminder that the share market is not the economy and that the active manager has a big role to play in how we interpret what this whole rate cutting cycle really means.
Yeah, I think that the active management can stand between the economy and the share market and make that distinction in terms of, well, where is the best place to allocate capital depending upon what's happening in fundamentally with earnings growth in the underlying economy, and how do we benefit from that?
That's awesome. Thanks for your time today, Al. I look forward to chatting again soon.
Great to see you, Pete.
Well, since recording that interview with Al, we've all woken up to the front page AFR news that the Australian Bureau of Statistics has recorded an increase in the underlying inflation rate to 3% for the year to September. This is a strong indication that a rate cut is a non-starter for Cup Day, and that perhaps this rate cutting cycle is going to be on pause for quite a while. Thank you for tuning in to FM Radio. This episode was recorded at Elston House. It was hosted by Peter Goodall, and today's guest was Elston multi-asset portfolio manager Alastair MacLeod. For more episodes and full transcripts of the interviews, visit elston.com.au. And if you'd like to subscribe to our podcast series to make sure you don't miss a thing, you'll find FM Radio on your favourite platforms, including Spotify and Apple Podcasts. The information provided in this podcast is general in nature. You must consider your own circumstances prior to making any investment. For more information, go to elston.com.au or speak to your financial advisor. Elston Asset Management is authorised by EP Financial Services, AFSL number 325252.